On June 25, 2020, the world learned that a German payments giant had fabricated Euros 1.9 billion in cash that simply did not exist, sending shockwaves through global markets and exposing the darkest corners of modern fintech. Wirecard began in 1999 as a modest startup in Munich, founded by former banker Markus Braun and a group of engineers who saw an opportunity in the nascent world of online payments. In its early years, the company rode the wave of e-commerce, providing merchants with a simple way to accept credit cards over the internet. By 2005, Wirecard had secured its first round of venture capital, and the promise of a seamless, borderless payment experience began to attract investors hungry for the next digital disruptor. The firm's rise was meteoric. In 2008, Wirecard listed on the newer market, a subsegment of the Frankfurt Stock Exchange designed for high-growth tech firms. The IPO was modest, but the company's aggressive acquisition strategy soon turned it into a behemoth. Over the next decade, Wirecard swallowed more than 24 rivals across Europe, the Middle East, and Asia, each purchase adding a new stripe of revenue and a fresh layer of complexity to its balance sheet. By 2015, the company boasted a market capitalization of over Euros 5 billion, and its stock price had multiplied more than 20-fold. The narrative that the market fell in love with was simple. Wirecard was the European answer to PayPal and Square, a technology-driven alternative to traditional banks that could process transactions faster, cheaper, and with fewer regulatory constraints. Its CEO, Markus Braun, became a charismatic figurehead, frequently appearing at tech conferences and promising that the future of finance is already here. The company's annual reports glittered with figures: Euros 2.8 billion in revenue in 2018, a profit margin that outstripped many incumbents, and a sprawling network of subsidiaries that seemed to prove the firm's global reach. Yet beneath the polished facade, warning signs began to surface. As early as 2015, a small German research firm, KPMG, flagged inconsistencies in Wirecard's accounting for its Asian operations. Journalists from the Financial Times and the Wall Street Journal published a series of investigative pieces describing opaque corporate structures, suspiciously rapid growth in regions where the firm had little physical presence, and a pattern of delayed financial disclosures. Former employees whispered about a culture that rewarded results above all else, where auditors were pressured to sign off on numbers that didn't add up. In 2016, a whistleblower known only as Mr. Y sent documents to regulators alleging that the company's trust accounts in the Philippines were fictitious. These red flags were largely ignored. Germany's financial regulator, BaFin, historically took a hands-off approach to fintech firms, viewing them as engines of innovation rather than subjects of scrutiny. Wirecard's auditors, Ernst & Young, repeatedly issued clean opinions, despite internal memos that suggested they had struggled to verify the existence of cash balances in third-party escrow accounts. The company's stock continued to soar, and analysts praised its disruptive model and unprecedented growth trajectory. The illusion finally cracked on June 18, 2020, when a short-seller research firm, Short Squeeze, published a detailed report alleging that the Euros 1.9 billion listed as cash in Wirecard's 2019 balance sheet was in fact non-existent. The report cited leaked documents, bank statements, and testimonies from former employees who described a phantom cash operation designed to inflate the company's liquidity. Within days, Wirecard's share price plummeted more than 80%, and a wave of panic swept across the Frankfurt Exchange. In a desperate attempt to salvage credibility, Markus Braun called for an emergency audit by EY, demanding that the firm verify the missing cash. When the auditors failed to locate the funds, Braun announced on June 25, 2020, that Wirecard could not confirm the existence of the Euros 1.9 billion and that the company would file for insolvency. The announcement sent the market into a frenzy. The DAX index tumbled, institutional investors scrambled to liquidate positions, and regulators worldwide launched parallel investigations into the firm's operations. The fallout was swift and severe. Within weeks, Braun was arrested on charges of fraud, embezzlement, and false accounting. Former CFO Jan Marsalek fled the country, becoming one of Europe's most wanted fugitives before disappearing altogether. EY faced a global credibility crisis, prompting a wave of lawsuits from shareholders and calls for stricter auditor oversight. BaFin, once praised for its innovation-friendly stance, was forced to acknowledge systemic failures in its supervisory framework, leading to a comprehensive overhaul of Germany's financial regulatory architecture. Beyond the legal drama, the Wirecard collapse exposed a broader vulnerability in the fintech ecosystem: the ease with which technology companies can mask financial realities behind complex corporate structures and rapid growth narratives. Investors, eager to chase the next unicorn, often overlook the fundamentals of cash flow and asset verification. The scandal sparked a worldwide debate about the role of short sellers, the responsibilities of auditors, and the balance between fostering innovation and protecting market integrity. In the aftermath, the German government introduced the Wirecard Act, tightening reporting requirements for payment service providers and mandating real-time monitoring of cash balances held in third-party accounts. The European Securities and Markets Authority, ESMA, issued new guidelines on auditor independence, and the International Auditing and Assurance Standards Board, IOSP, accelerated reforms aimed at detecting phantom cash schemes. Across the continent, venture capital firms became more cautious, demanding deeper due diligence and insisting on transparent governance structures before backing fintech startups. Subscribe to The Collapse for more stories like this.